This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Tom Lambeth, thanks very much for coming back on Talk Your Book. Been a regular of the show. We'll get into your stock pick in a second, but I thought if you could start with giving us an overview of VP Capital and how you guys look to invest.
Thanks, Chris. Good to be here. I think VP Capital is a long-short fund. We've been in existence for around 4.5 years. Our IRR since inception has been circa 25% net of fees. And we're quite opportunistic and open-minded with how we go about picking stocks. I'd say we're more of a medium-term house. We're not sort of day traders, but we're not sort of buy and hold forever either.
And we sit here on a day where the market is shooting the bed, which is a technical term, Tom. But talk me through your short book. What sort of percentage of shorts have you got on at the minute?
Not enough, Chris. We're looking at low single digits, a gross short. We had been a little bit higher than that, but we made the decision to close some. It's very hard to pick the exact day the market's going to tank. So what we try and do is just sort of take a little bit off each way, and then vice versa on the long side. Try and take shares off as they appreciate. Obviously, it's a difficult market at the moment. So if you're net zero, net long, then you're killed. And if you're net short, then you're loving it. So.
And what stock do you want to talk about today?
Cooper Energy.
And talk me through what's their business model.
Yeah, so Cooper Energy's been around for a while, sort of circa 20 years in its current form. The last sort of 10 years or so, it's really made a strategic refocus to look at East Coast gas in particular. It was, the name comes from the Cooper Basin. It used to be really an oil producer in joint venture with Beach. And then it did some sort of crazy things early on where it was exploring internationally in Tunisia, Romania, Poland. It got out of that racket and really made a decision to go after the East Coast gas market, which I think, in hindsight, it's sort of been vindicated in doing so.
And so we might dig into the uniqueness of the East Coast gas market in a second, but talk me through where are their gas deposits held, and then where are their gas hubs, and how do those two assets interact?
Yeah, sure. So there's two main assets. There's really one. There's the Gippsland Basin, which has sole gas, and then there's the Otways, which is sort of a minor proportion of their revenue, but nevertheless they sort of generate circa sort of 20% of their revenue from the Otways. So both sort of gas methane production hubs. They own one of the gas processing facilities in the Otways, 100%, and then they also toll treat the other one. So Sole Gas is completely toll treated via a facility which is owned by APA, and they pay around $4 a gigajoule to have that toll treated into the domestic gas market. So most of it's contracted. Certainly all of the gas is contracted from the Otways, and most of the gas from Gippsland is contracted, but there is a portion of it which is uncontracted, which is being sold into the spot market, which makes Cooper quite an interesting play.
And so what's so unique about the Australian East Coast gas market?
Yeah, so I think on the macro side, there's been a chronic underinvestment for a long time, and on one hand you've got rising demand domestically, but also don't forget we've got the LNG facilities in Gladstone, which are exporting all of the Australian domestic gas to Asia, and so you've had this crunch where now there's a shortage of gas. Now
it's just wild to think about that, isn't it? Like, we're one of the biggest gas producers in the world, yet there's a shortage of gas to use in Australia. It's really odd, isn't it?
Yeah, it's not ideal. I think from a policy perspective, you'd hope it was the other way. I think what's happened is the state governments, certainly New South Wales and Victoria, have been almost anti-development with respect to the fossil fuel development. So New South Wales still has a moratorium on onshore gas development. Victoria effectively does as well. We've made it technically legal as long as you're doing conventional gas development, but CSG and fracking is effectively outlawed, and so the only state which allows economic gas development at the moment onshore is really Queensland. And so that's why you've seen, off the ASX listed players, there's small to mid caps like Comet Ridge, Blue Energy, State Gas. They're the public ones that are all listed. All of their assets are in the Bowen Basin. Looking further abroad, there's obviously the larger companies like Santos and Woodside and Beach, but they have assets really scattered all over Australia, including onshore and offshore. Cooper itself is probably the only pure play listed East Coast gas producer, where you're getting literally almost a one-for-one, bang for your buck, exposure to the East Coast domestic gas market, which is really what excites us at VP.
And talk me through that HPC released a report just showing how significant the difference was from gas supply on the East Coast to demand. Just try and give the viewers an indication of just how big that differential is and how long potentially that could last.
Yeah, the dynamics are fascinating. So when you have government bodies and even the regulators talked about longer gas prices, sort of higher gas prices for longer rather, it really does sound the alarm. So to give you some context, the long run historical East Coast gas price has been under $10 a gigajoule. In recent times, it's kind of crept up to $10 a gigajoule in the spot market. It's lower in the contract price market. The ACCC report's talking about prices that are going to be well north of that. Indeed, in the spot market today, we have prices that are $40 a gigajoule, and it's worth noting that price is actually capped. So the regulator has intervened in the market in recent weeks to cap that price at $40 a gigajoule. The true price is actually well north of that. It's in the hundreds of dollars a gigajoule if you just look at supply-demand fundamentals.
And does capping that price in effect mean that difference between the supply and the demand is going to go on for longer because people aren't incentivised to increase supply?
Well, that's right. It does remove the incentive. It's worth noting, though, I have to temper that in the short term, that's driven by really the cold winter, in Victoria and in New South Wales, and also some of the coal-fired power stations have been sort of shut down for maintenance. So, there's been a refocus on gas, and it's really put a lot of pressure on the system. That said, if you look at the long-run trend here, every year you've got a curve which is stepping up. So yes, it may be seasonal, and if you want to criticise what I'm saying, you can say, well, it's all seasonal, and that's to some extent true. But if you look at 22 on 21 and 21 on 20 and so on and so forth, the curve which is stepping up is just materially higher every time. So we can see a case where you could have medium-term gas prices well north of $10 a gigajoule. 15, 20, I don't think wouldn't be out of the question at all. So,
and do you think we'll get into the numbers for Cooper in a minute? But do you think on a broader base, having that differential in energy price, will it lead to manufacturing jobs and things being set up in other states where there's a more reliable, lower cost energy supply? Or do you think businesses wouldn't take that into account when they're setting up?
I think possibly. It's very hard to, once you've built, a massive plant, like look at, Qenos in Victoria, here in Altona manufacturing plastic, that's a massive operation, billions of dollars of sunk cost. You're probably going to stay here for a while, but, that said, you're right at the margin. Those, call it more, free market states like Queensland will inevitably attract more jobs and more investment if they have more of a laissez-faire towards investment.
And talk me through the numbers. What's Cooper's market cap? What's their debt profile?
Yep. So the market cap's around sort of 550. They have around $200 million of gross debt and about 100 of sort of net debt. So you're talking sort of an EV of close to 700 all up, with some provisions. And last year, they made sort of circa 150 million of revenue. We think that they'll continue to do that because most of their, as I said, their revenue is contracted. It's via a GSA. And then on the EBIT side, historically it's sort of between 20 and 50, but we think that's moving up to sort of more like to sort of 70 million or so this financial year.
in a corporate sense, like they'd have the ability with that sort of balance sheet to move on some bolt-on acquisition if they wanted, or do you see Cooper as more being a potential acquisition of a larger player?
I think they're more likely to be a target, and their balance sheet it's not stretched, but it's not a huge amount of headroom. Don't forget they've got to pay off that 200, because it's secured against the reserves of Sol gas, and so there's a pay down profile there, which should suck up most of their free cash flow in the short to medium term, and so if they were to do any acquisitions, it's more likely to be strategic in a sense that they may acquire the Orbost plant from APA, for instance, for maybe a couple $100 million, and that'll have to be funded via an equity issuance, I suspect, probably a rights issue, given the size of the market cap. That's an interesting deal. I think it could be, digressing a little bit here, but it could be accretive, that particular deal, given they're paying APA, call it $80 million a year to process the gas, and Cooper is trading on 10 times. Making a 3 times acquisition, should be accretive. So let's see whether it happens or not. It's likely to happen, I think, in the next few months if it does.
And who would be the natural acquirer of Cooper?
Really anyone, because particularly, I think in industry with a real strategic angle, like I mentioned Qenos, if you want to secure your long-term gas supply and you're heavily reliant on gas as an input to make your products, then it makes a lot of sense to go and buy spare petajoules. And yes, Cooper has most of it is, it's contracted, but there's still a very large component which is uncontracted from just a pure petajoule perspective.
So you could see a completely non-sort of gas player
Yep.
potentially jumping the market just almost as a hedge against rising gas prices and security of supply.
Absolutely.
Huh. Where do you think those EBIT numbers could get to if you look out? I know you're a 6 to 12 month down the track sort of investor, but if you do take a slightly longer lens to it, maybe 2 to 3 years, where do you think they can grow that EBIT profile number to?
So this is the really interesting part, and it's really the crux of the matter about why we are interested in this play. So some quick numbers. At the moment, they've just concentrating on Sol gas because that's where the upside is, the Gippsland asset. They've contracted to do 47 terajoules per day into the domestic gas market. Now, the nameplate capacity of that operation is more like 68 terajoules a day. So there's a lot of room there. It's not operating at capacity. It hasn't for a variety of reasons, and we can get into those. But that's the upside. All of that margin is completely uncontracted. So we're talking about a situation here. If you manage to increase it even to say 60, that's potentially an extra 4 to 5 petajoules per year of gas. Now, at spot prices, that's a lot of money. At $40 a gigajoule, we're talking about an extra, potentially $200 million of revenue at very, very high margins. Given their all-in costs, it's more likely to be circa $5 a gigajoule. So,
and what are the constraints to getting that site up to capacity?
The problems which have been well documented, it's been an issue around purity of methane, and there's been some sulfur content that's higher than expected. They've needed to spend some additional money installing some new equipment and really improving the plant's capacity to process the methane. And we don't have a particular view that's high conviction about the likelihood of success on that particular operation. But what we do know is what's the downside here, because it's almost like a infrastructure-like play. It's on 10 times cash flow. It's contracted. It's got a 10-year field life plus. The upside is potentially you're doubling or tripling your earnings. Who knows on the upside? But would I pay 10 times to I guess have the option to maybe get some of that upside if they manage to execute? Absolutely, yes. And then my downside, I think, to look at the share price to it's really range traded from 25 cents to 30 cents for a long time. In the meantime, Beach, Santos, Woodside have all taken off, and so Cooper has really been the underperformer for these operational reasons, as we touched on. And I think that's where the opportunity is.
In terms of the pricing cap that's implemented on gas, could you see a shift in that, or do you think that's pretty much set in stone for the foreseeable future?
Yeah, I think it's unlikely, given the politics of it. I wouldn't bank on it. But what I'd say is you don't need, those spikes are probably unhelpful, for the market to operate in. It doesn't provide confidence for anyone. So I can see the regulator's perspective here. What I'd say is Cooper doesn't need gas at $300 a gigajoule. It just needs gas at even $15 or $20 a gigajoule for this to make a lot of economic sense.
And more broadly, talk us through, how you're viewing this. There's obviously a huge undersupply of energy in the current world market. We know there's a war in Ukraine, which has been devastating, obviously on a humanitarian level, but also on an energy supply level. How are you viewing it in a macro sense? Are you viewing the energy landscape as one that's going to ease when and if that war in Ukraine finishes up? Or do you think the energy price rise we're seeing now is really more of a secular trend due to the underinvestment that's been made, particularly in a lot of Western countries, around energy of all sorts?
I think the latter. Certainly with gas, it's a case that the Australian East Coast is really like an island. In many respects, it's too far from anything to really pipe economically. So
it's probably important to point out the gas price is different to oil, isn't it? I mean, oil, there's a price for oil that's pretty much the same all around the world. Gas prices are quite different. The US gas price is different. The European gas price, as is the Australian gas price. Is it worth just pointing out to the viewer just how different those gas prices are around the world?
Yeah, I think that's spot on. The Australian price tends to be a function of the supply on the East Coast plus the Asian demand and what they call the LNG netback price. And that really operates in its own single market. In the US, it tends to be a bit more stable. It's probably a little bit more integrated. Yeah, so I'd make that point. It's very different from oil, which is a globalised. It's either Brent or WTI. And so it's really one of the reasons why Cooper decided to make that strategic refocus a while back, 7 to 10 years ago, to really focus on just the Australian East Coast, because they could see this coming. It was a supply crunch plus a continuation of the domestic plus the Asian demand story.
And what would they have to get their debt profile down before you could see them actually, paying dividends or looking to do a buyback or some sort of capital initiative?
Yeah, I think that's an interesting question. I haven't banked on that in my thinking. I've really thought about it as I want to buy the equity because it's almost like a free option to almost achieving a certain nameplate capacity and then being able to print a lot of earnings from that. But you can run the numbers if you can generate even between 100 to 150 million of marginal EBIT, at spot for even a short amount of time, then that's obviously highly cash generative.
And I'll let you finish in a sec, but if the energy crisis we're seeing now is due to more of a secular underinvestment in energy, where are we in that cycle before that supply comes on and the prices ease? Are we, potentially 2 years into a 10-year bull market, or how long do you think this can potentially go on for, albeit when the data changes, you'll change your mind?
Yeah, it's the latter, but I'd make the point that I can't see it immediately ceasing. The problem is here, and it has been for a long time. If you look at the projects that are coming online, Santos has got Arcadia. There's a couple of projects in CSG projects in Queensland that may or may not come on in the next sort of 5 years or so. There's no one big project which is going to solve the supply concerns. And
they're such slow-moving projects. Even if there was a new project that was brilliant, it'd be 10 years if it would have just got discovered before it could actually sort out supply.
Yeah, that's spot on. So I think what could change, it's probably worth noting that if there was a regulatory shift, almost a political shift, which I don't think will happen at the moment in this climate, but if there was, at state level, if you had suddenly a big push for deregulation in New South Wales, that could unlock many of the Santos assets, and they could suddenly be developed within 3 to 5 years. But you're still going to have a lag. There's CapEx and there's FID to go through, and so I don't see this changing in the medium term.
And the political landscape, if you looked at the federal election results, we look in terms of how the Teals went and the Greens went, it doesn't seem like there's voter appetite for that shift currently. It seems prices would have to be even significantly higher from here before a majority of people came around to that idea. Is that fair?
I think that's right. Coal's probably worn a lot of the scorn here, but gas is certainly still, in the sort of targeted. So my perspective would be, nationally or at state level, it doesn't seem to be the political appetite to reduce prices in the medium term. Unless the other sort of political thing we could do as a country would be to insist that the GLNG, Gladstone plants and APLNG, QCLNG shift their gigajoules from Asia back into the domestic market, and that would just send, in my opinion, completely the wrong message for Australia, because it would undermine the confidence. Now, keep in mind, these projects are billions of dollars.
And we haven't had the capital to fund them ourselves historically, have we?
Yep. So we would take in my opinion, a national hit in terms of quality of rule of law and confidence in investment if we decided to go down that track, and for political reasons, which would be to shift some of the export market back domestically. But it's a lose-lose situation here, because either you're going to have heat domestically, higher gas prices, retailers, consumers suffer, businesses suffer. That's politically unpalatable as well. So
I just thought you'd be a chance politically to get handouts for low-income earners or for businesses that are heavy gas users as step one. Could you see that as being a logical step politically, which in terms of companies like Cooper would just end up being a boom?
Yeah, possibly.
Because it's not going to stop supply. You're helping out some of the people who are being crunched. You're still buying votes, but you're not crunching actual supply, which is going to make the situation even worse.
Yeah, there's many ways you could do it. You could also have a lower cap, for instance. Instead of 40, you could even have a lower cap there for businesses. But
they're all what ifs, I guess. You've got enough. There's enough low-hanging fruit to make it an attractive opportunity in the interim. So, mate, it's a good one. Thanks very much. It wasn't on my radar, so it was good to get some exposure to, and we'll put it on the watch list for sure. Thanks, Tom.
Thanks, Chris.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.